What is going on, guys? Welcome to Stock Talk with Nico Criticos. It's been a while since we've done a video here, but today we're going to be doing an update for a stock that I have purchased just a couple months ago, and that is going to be ticker EVVTY, or otherwise known as Evolution. Now, this stock is not traded on every platform. It is not on Robinhood, and so I had to buy this through my Fidelity account. But the thing that has happened with this stock is so almost a year ago now, the stock was trading at over $130 a share, and now it's all the way down to 77. The last time I bought, I believe, would have been right here. It would have been October 2024. I remember buying in the 90s. Okay. Then the stock shot up, and I think I sold all of it that day. And I forgot how much I made, but I probably made whatever 15-20% on it in a short period of time. It was probably a couple of weeks or something. And luckily, that turned out to be the best decision because since then, the stock has come crumbling down now. And so you go look at the financials, are not bad. There's not much, I'm not seeing a whole lot of bad things with this company. So we have a $16 billion company, which is not cheap, but the company is profitable and their numbers are growing. I mean, you look at their revenue numbers, 715 million 4 years ago, and now they're up to over 2 billion. You look at net income and free cash flow, same thing. These last couple of years have been super consistent, right? Look at that trend. Now, you might say the last year or two, maybe the growth was a little bit slower, but it's still trending upwards, right? EPS, cash to debt ratio is solid. We're looking at 700 million in cash with only 70 million in debt. They do pay dividend, return on capital, like shares outstanding. All these numbers look good, right? Look at the ROI number just peaked at 9%. That's for the quarter too. So let's look at this on a. I'm very excited to see what they do for this last quarter from 2024. But here, let's go here. So 2023, 26%. No, we got to check trailing 12 months. Let's go to trailing 12 months here. And that should be right. No, that's not right. Okay, that's it's still different. It's still we'd have to add these up. So really it'd be like it's probably, over 35% now. So all those things look good. Now, I'm not going to say this is a risk-free company by any means, but just a lot of things look solid. Profit margins 57%, that's insanely high. Free cash flow yield 7.5%, insanely high. Dividend yield is, I mean, it's 3.5%, but that payout ratio is just ridiculous. So I don't know what's going on there. But I mean, this valuation is getting pushed down further and further. I mean, trailing PE of 13 and now a forward PE of 10, that's insanely cheap. Most of the time, like a Walgreens would be priced at that or something, a company that doesn't grow or that's losing revenue or something like that. This company is not doing that at all. This is a growing company now. And let's look at let's see, what's their average net income growth? These last couple, even the last 5 years, 55%. Look at this growth the last decade. The growth has been insane here. So I think the stock could be trading at 40 times earnings. Really, you look at some of these other stocks that, you know, trade like this. It's probably because I mean, it could be because it's not on mainstream markets, but even that's not even a good excuse. This really, it's just trading cheap. Okay. And but again, what I was trying to say was this is not a risk-free company. It's not like buying an Amazon or a Meta. So this thing could, hypothetically, it could drop 50%, 60%, and whatever. But keep in mind, the stock's already down a lot, right? Like how I just said, this stock was $135. So we're already down, almost 50% now, right? So you got to think the market cap would have been nearly double. Now this is a Swedish company, which is so it's an ADR, which is again not something I like when it's ADR, and that's probably a big reason they're not on platforms like Robinhood. But still, the point is the market cap is nearly half now, and these little AI things that pop up here between for pretty much pros and cons of the stock, they're pretty good. I have to say the thing I like about this is both when you read both sides, it's always very extreme. Like they're always picking out the competitive advantages normally sound really good, really strong, lots of good things going for the company. And then the risks always sound kind of extreme. Like, oh, they might, lose business here, or this is that. There's lots of dramatic things. So you kind of look at both sides, you say, okay, I mean, a lot of this seems unrealistic, but I mean, if they have a couple of these good things going for them, like them expanding into new markets, releasing new games, and their market share and their reputation, the cash balance. There's lots of positive things going. Let's look at, let's see. So we're looking at, I mean, EPS is expected to go up. Let's see if there's not going to be a lot of analysts covering this stock because it's a a small cap ADR, just like over the counter stock. But I'm still curious to see if there's any estimates. But all I'm saying is the risk to reward is getting a lot more attractive for the stock. I bought some, yeah. See, well, okay. So they're expected to do 16% revenue growth this year and then 12%. So not high growth, but still pretty solid. 2.5 billion of revenue. Remember, we'll call, yeah, 2 billion. So we'll say this year should be roughly 2.3 billion, right? Remember, those profit margins are now at, let's go back here. Profit margins are what, 58%, 60%? So I mean, this company can probably do, like, they could do at least a 1.5 billion dollars of revenue, or 1.5 billion dollars in net income for 2025, which means, again, you're paying 10 times earnings, which is insane. That's insanely cheap. This is priced as if it's going to go out of business or something, or this is, it's priced nearly for the end of the world. Now, sure, again, theoretically, it could trade at 5 times earnings, right? So there is some risk there. That's why I personally keep it a small position of my portfolio, and I make sure to, be okay with if I'm going to lose that money. But at the same time, I'm willing to take that chance because I think this stock could easily 2x, easily. There's no reason. Their numbers look good as long as they don't get banned or something crazy doesn't happen. Their numbers are going to keep going. Their numbers have been going up. So as long as they keep up with that PE ratio, first of all, it's ridiculous that it's trading at 10 times earnings. But if let's say it could easily double to 20 times earnings. I don't see why not. And you could also look at it like, what if it does get put onto Robinhood or something like that? That's another positive catalyst. So let's go back down here. So yeah, sometimes it'll show you like what the insiders are doing and stuff. Looks like not for this one. So I don't know. It's an interesting one. I'm gonna say it's there's definitely some risk to it, but I think it has huge upside potential. And this is one where, I would not be surprised if the stock doubled over the next 12 months. So that is my analysis for this one. Let me know what you guys think, and let me know if you are going to be buying that stock or not, or what you think about it. And if there's any more stocks you want me to do analysis on, just let me know. Comment down below.